So welcome everyone, and thank you for joining and listening in to learn about a very important topic, which is probably not the most exciting topic, but definitely very important to your real estate business. And so it's definitely one of the strategies that you've got to learn and you've got to employ and get access to a tax experts so that you can begin to build properly. And I'll tell you that it's really really important. Let me see. It says they're here. So sorry guys, I didn't even realize that I was missing people in the waiting room. So thank you for joining. I was just starting the presentation, so you haven't missed anything as yet. I apologize if I didn't catch everyone earlier. I couldn't see it on my screen, but yes, as I was saying, this is probably not the most exciting topic, definitely to spend a lot of time on in general as an real estate investor, or probably just in general, even if you're a worker, full-time worker. But it's certainly a very important aspect of what you need to do to be successful, whether you are doing it from the perspective of as a business, as a real estate investor. Tax planning is essential, and it can absolutely help improve your success and maximize your profits, and definitely help you find ways to save. And I think the best way to do that is to have an expert. If you don't currently have someone doing your taxes and you're maybe just using, software and or going to, for example, maybe the local plaza or mall or what have you to have it done, you might want to, as you build assets such as real estate and or investments in general, you may want to get the advice of an actual professional that can help guide you so that you can make the right decisions. I don't think it's sufficient enough to work with someone who may not get to know you and what it is that you're trying to accomplish over time. And especially if you're like myself and many people that we work with, you're trying to build wealth generationally. So you definitely want to employ the experts to help with that. They're not cheap, but they're worth it. So we're gonna, I'm only focusing on it as much as I know. I have to do the disclaimer. I'm absolutely not a tax expert. And I probably have, I think, an expert in-house here that might be able to help fill in the blanks, but I am working to help us get a tax expert on, if not our next call this month. We're hoping to get her later on in, or maybe early March. It seems as if, well, not seems, it is a busy time typically for accountants at this time of year. So it's not as easy to always get them lined up at this time, but I did ask in advance and she's just got a couple commitments. So our goal is to have definitely the expert come on and help you with some of what we're covering tonight and provide the professional expertise, as well as help us get maybe a bit more in-depth knowledge than I can offer. I'm really giving very basic surface level and just stuff based on my understanding. So I'm absolutely not the expert. I cannot claim to say that, you've now been advised and you know what to do and go out and do it. This is only a very generic and general, we're touching on the basics. We're also wanting to make sure that you understand the importance of it so that if you are thinking of what you're doing right now, it's tax season. Just about, you should be expecting to get all your tax slips by the end of February, early March, and you're starting to gather all your stuff. And so why not, preempt what you need to do for the next few weeks to months if you are preparing to have your tax done well in advance and or by the deadlines, which is April 30th or June 15th if you are self-employed. So in terms of tax planning, as I said, really important. It's probably one of the most significant areas of where you end up giving up a lot of your income over the course of your employment years or your business years. So it's really important that you understand and you, as I said, have an expert help strategize to make sure that you can take advantage of all the different deferrals that you have, deductions that you can utilize, the registered plans. There's just so many ways that you can, even when you're employed, have and utilize deferrals and deductions. So I think the most significant way to deduct and or reduce during the time that you're employed is probably using the registered plans, as well as over the years, the government has added the tax-free savings account. So the registered plans, meaning like RRSPs, right? They tend to be the best ways for someone who's employed to utilize reducing the tax burdens and the taxes that they pay to possibly help, provide them with a rebate even, which, depending on your income bracket and depending on how much you put away in a registered savings plan, you could see some of your money come back, some of the taxes that you pay come back to you, which is what I've always strived to do as an employed individual. Before, when I was teaching and working, I absolutely didn't want to leave all of the tax dollars that I paid in the hands of CRA, right? The government. I always wanted to find ways to get some of it back. And my best strategy was an RRSP. So if you're employed, use it, right? If you are self-employed, you will have access to a number of other ways. And we'll speak to some of it shortly in terms of the deductions. But you can as well, obviously, use the registered savings plans and the tax-free savings account. The tax-free savings account don't necessarily give you the deductions that you may be looking for to get that rebate, but it does allow your investments to grow tax-free, right? Which is huge. There's hardly any sources of income that you can generate in Canada, probably in North America and maybe most of the world, that isn't taxed, right? And so having the tax-free savings account, don't just use it as a savings account, use it as a way to invest and accumulate wealth, so that, because in that method, in that space, when it's in that vehicle, it will not be taxed, right? It's not taxed when it's accruing and growing within the tax-free savings account, nor is it being taxed when you pull on it and take it out. That's not the case for the RRSPs. The RRSPs go in and you get the tax deductions or the tax.
Cars, it's a smart car.
Sorry, hello?
Okay.
I'm sorry, I just heard someone saying something about a smart car. Maybe it's just they weren't muted. Anyhow, you have the tax-free savings account that when you put money in, you're not getting a deduction like you are with the RRSPs, but you are allowing the growth and the accumulation within that vehicle to not be taxed, not during the time it's accumulating, nor when it's pulled out. So, and by the way, I did have a few people submit questions, but if you do have questions along the way, absolutely type it in the chat or, raise your hand so that I can try to answer it. And of course, if I can't, I absolutely will make sure that we save it for this lesson that we'll have with our tax expert that's coming on. We're hoping to have possibly two, one at the end of the month and one early March, so that we can, pick their brains and use their knowledge, not just for tax purposes alone. We're going to talk about different vehicles that you can use to structure your, what you want to do in terms of real estate investing or business. So these are all the ways that they're not all. This is a list of some of the ways that you could utilize in terms of tax deductions. There are definitely others, but I've just listed what I felt was a fairly good list for someone who is in real estate investing. There's absolutely more ways that you can, and other ways for tax deductions to be utilized by you and I or someone else who works in Canada or has been building and accumulating businesses or real estate, right? So in general, and I think this question was one of the ones that was submitted for someone asked, if I have a real estate or a property and I have done some renovations, or you've done some upgrades, or you've even just finished a unit, are the expenses associated with that upgrade or those finishes tax deductible? And I don't think they were just saying, are they tax deductible? They were also saying, are they tax deductible even when I don't have the unit rented? And absolutely, they are tax deductible, even if you haven't yet rented the unit. If the goal is to rent and you're just still in the middle of finding a tenant, which right now, for whatever reasons, tenancies aren't happening quickly, then yes, absolutely, they're deductible. Okay, so you can still utilize those expenses and add them to, and I'm assuming the person is also asking because the property is in their name and it isn't in a corporation or a business. And so, they're wondering, can I use the deductions against my own personal taxes? And you can. So any questions about, I'm not going to list them all. These are some of the ways that you can deduct, along with the registered plans that I covered on the previous slide, where, if you're looking for ways to get back, some of your taxes that you paid out, you save the receipts, you save the documentation, you pass these all on to your tax experts, and they'll help you utilize them to offset your income, right? And so just note that it's really, really important to keep records, and not just to keep records for current year, but to keep them for typically, from my understanding, it's 7 years back. We can always verify and confirm those numbers with the tax expert when they're on with us in the upcoming weeks. But you should be keeping them for, especially when you're speaking to CRA, and if you ever have to be audited or called on to demonstrate, because typically you're not submitting all the receipts when you're filing. You are only required to probably submit, just the T1 general or the different forms that attach to that. So keeping the receipts and keeping all the documentation will be really useful if you ever get audited or called on to supply evidence of those records. Disclaimer again, I'm not a professional. I'm not a tax expert. I didn't go to school for any of this. I've just learned some of it over time. And I've learned some of it in what I did before in financial services, and some of it for my own personal use. And so I'm only really speaking from my own personal experience. With respect to capital gains, does everyone understand what we mean by capital gains when I say that? I see someone type. Okay. Yes, so the question, sorry, if anyone wants to answer, I'm absolutely open to having people interact. Rachel asked, does capital improvements include HVAC installation? Absolutely. Anything pretty much that you're doing on your property, especially if it's a property that is generating rental income for you, or is, because I'm assuming too, Rachel, that it is a property that is rental, or you have some aspect of it rented. And then yes, it is used as, it can be used as a deduction. Okay. Sorry, someone else had their hands raised, or did I miss that? So
No,
capital.
I
Yes.
had my hand raised. I was gonna, because you were saying to answer the question, but I, I, I was like, never mind, because you already answered it.
Okay. Well, did you have to anything to add to it?
No. I was just gonna say what capital gains was to like give an example, but you already gave it.
Okay. So capital gains, definitely really important. It's, I don't know, for whatever reasons, it's one of the things that over the years, as I built my real estate portfolio, everyone almost wanted to discourage me from investing in real estate, because they're like, oh, but you'll have to pay capital gains. I'm like, yes, I'm okay with paying taxes. I'm actually okay with paying taxes in general, because it means I'm making money and it means that I'm building wealth. I mean, I absolutely want to find ways to reduce how much I pay, and especially doing it legally and doing it efficiently. But I don't mind paying taxes. So capital gains, yes, you are going to pay taxes on assets that you accumulate over time, and capital gains could be incurred when you speak of stock, real estate, bonds, anything that grows in value over time. And the original price, say your original purchase price is say 10,000, but maybe you've had it for 10 years, and now it's worth 30,000. The difference of 20,000, right, from the original purchase price, that's a capital gain, and that's subject to tax liability. And when it's a capital gain tax liability, it's typically going to be 50% of it is subject to taxes at your tax rate. So it's not that you're paying 50% on the whole 20,000. Say if I'm in a 50% tax bracket, because let's just role play. If I'm in a 50% tax bracket and capital gain says 50% of it is taxed, well, 50% of the 20,000, which means that 10,000 of it is subject to taxes at my tax rate. So then I pay 5,000 in taxes, right? I mean, I think it's easier just to use simple round numbers. And so that's where, I've made money, and guess what? Uncle Sam or whatever, CRA wants a piece of it as well. And so that's what the expectation is. And so some people are discouraged by that. They're like, well, I don't want to pay taxes. And it's like, or, they do things maybe under the table, and maybe they can find ways to avoid paying taxes. But typically that sort of stuff, if you're trying to avoid it and it's something that you've done through a legitimate source, it will come back and bite you eventually. So, better you stay on the up and up. And I'm not, saying that there isn't. The other question that I'll answer later asks, what if I acquire assets abroad? Am I expected to pay taxes in Canada? And, I would say, well, it depends. Are they reporting to Canada? Because if they're reporting to Canada, then yes, you're expected to pay taxes. But if they're not, then no, there's no taxes owed, right? And not every country, not every part of the world reports to Canada. If you're investing in the United States, yeah, they will report. And so then the expectation is those assets that you accumulate in the US will be subject to taxes there and here, right? So ways to reduce capital gains, and you're always going to try and find ways to reduce taxes, because that's the whole point of, trying to keep as much of the assets and the wealth that you're building, right? Is to find acceptable tax strategies, either to defer and or to reduce, to deduce and take off, right? So you're going to try and always find or even tax sheltered investments, right? I mentioned some of them at the outset. So for example, you can hold on to the longer you hold on to an investment, the obviously the better for you, because it's growing and accumulating and getting larger and larger over time. And so, as much as I said on my last slide, people tell me, but Andrea, why would you want to pay capital gains? Well, I want to build wealth. And I thought, if I build wealth and it means that I have to report and declare, I'm okay with that, as long as the value, right, is greater to me at 5-10 years into the future than it is now, right? So, and that's typically going to be the case when I'm buying real estate and stocks and or any type of asset, even art, right? Go ahead, Jermaine.
Yeah, so I was just wondering, how in America they have 1031 exchange where you can sell and then defer the payments, where you can roll the capital gains into a new property. Does Canada have something like
I'm
that
going
as
to
well?
come to that, Jermaine. So
Okay.
we don't refer to it as a 1031 here, not to my knowledge. We've got another name, but I do understand that concept and we'll come to it. And yes, you can do those things as well. So we can also utilize tax shelters, and that's what I mentioned in terms of the registered savings plans, the tax-free savings account. They even have, ones for you to save for buying homes. So there's all sorts of tax shelters that you could utilize to help reduce taxes, both today and in the future. You could also if you create losses over time, you can use those losses to offset gains, and the losses can be carried forward.
It's done.
Sorry, is someone unmuted? I keep hearing. I don't know if it's me that I'm hearing something. Okay, well, so yeah, so then you can carry forward losses and use them if you don't have any gains to offset them with in the year that you incur them. They can be carried forward. So so you're not always the expectation isn't that you always pay it immediate, or you use the loss immediate. You can always push similarly. You can find ways to defer, as I said, like legitimate ways to defer taxes. So taking advantage of any tax deferred options, for example, the principal residence exemption. And I mean, most of us typically don't have to pay taxes or capital gains taxes on our principal. Now, obviously, that has to be evaluated and looked at. And every time I sell a property that was my principal res, I have to file, additional paperwork with my taxes that year to verify that it was a principal residence. So you are exempt as long as the property can qualify, right? So there are certain requirements that you have to meet in order to show that it was your principal residence, and then it's not subject to capital gains tax liability. You can also donate as well, and it could be to any type of charity that you choose. You can, in general, when we do provide donations to charities, we also get charitable donation slips or tax credits, and those can be utilized to help reduce and offset capital gains and or reduce your tax liability. So all legitimate ways, probably many others that I'm not going to. I'm hoping that the expert, when they come on, they can also help us understand more, right? So this is probably speaking, is this, let me see, sorry, just a minute. Yeah, no, I'm coming to that. So Jermaine, maybe this is kind of what you were speaking to, right? And I don't understand and know as well the tax scenarios in the US. I just have some understanding of taxes here as a Canadian. So if you have passive activity losses, for example, passive activity loss refers to, we've talked about passive income before. So if you're generating passive income through, examples are here, leasing equipment, real estate. Oh, I noticed, just saw 2 E's on my real estate there. Real estate rentals, which is applicable to myself and individuals like you who are investing in real estate. Those are considered passive activities, right? You're not actively generating income through those methods, and so they are considered passive income. So passive income, those losses, typically, if you incur losses in those, you cannot use them to offset other income, right? Or your income in general. And so I mean, we will all at some point have some sort of losses in our real estate business, in our real estate investments, and those losses are treated very differently in terms of they can't be used to offset our personal income, right? So this, I'm hoping that our tax expert, when they come on, they can shed a little bit more light so that we can understand it a little bit better. Because as I did some research, I was kind of like, I understand very generically that, yes, I understand it's passive. All of real estate, pretty much, when you're doing rentals, for the most part, it's passive. There's very few active activities. If you buy and hold real estate for long term, you're generating rental income, and it's considered and deemed passive. It's not something that you and I are there. You go out, it's not like a job that you go out to work and generate income. So it's considered passive income, right? And so that if there are losses incurred, you just have to keep in mind. And it's not my position all I'm doing is reporting to my accountant, and my accountant is taking care of and ensuring that I report it accordingly and apply it accordingly to my taxes. Is there anyone that has information and or wants to be able to add to that for us at all, that has a better understanding than I do? No? No, it's okay. So one of the key things that I wish I had learned really early on in my real estate career is, how to utilize structures such as these, because I at the outside, I didn't really understand, and everyone sort of advised, everyone that didn't understand or know themselves, or maybe weren't even in the field, would have their have an opinion on what makes most sense. And so I started off and I held, I don't know, probably 7 or so properties in my name, which probably wasn't the best way, obviously, to start off. I think it would have been better to start off with a corporate structure. Maybe not on your first 1, 2, or 3 purchases, especially if they are, I would say, single residential, maybe not multi-units. If they're multi-units, absolutely start with a corporate structure. But you have to decide at the outset what entity or structure will make most sense for you. Is it that you want to operate under a sole proprietor, or you're just going to run it under your own personal name, and or a corporate structure, or in some cases a partnership? And then again, you don't have to know yourself in depth what makes most sense. You have to just explore with a tax expert and possibly your lawyer to determine, based on where you are and where you plan to go, what makes most sense. Because at this point in my career, there's no way I want to make any decisions singularly, like I did in the outset, because I feel I don't want anything to bite me. I don't want anything to go awry and cost me, because it typically costs a lot more to make mistakes. And so I would highly encourage you, if you are, still fairly new and not 100% sure, but you have an understanding of where you want to go and what you want to accomplish, get the advice of the experts. And you might have to start with the lawyer to decide, to then have the accountant on board to help make sort of fine tuning what makes most sense, so that you, because typically it's not the accountant that will set up the structure. They can. I've had my accountant set up some, but you can also have your lawyer do that as well. But it's just that the accountant will help you understand the tax consequences that could arise in each structure, or what would make most sense depending on where you're trying to be over the next year, 3, 5, or 10 years, right? So again, you can read and look into, and you can always come back to listen to these, but each of these structures are fairly straightforward. It's highly likely that you're either going to use one, so the sole proprietorships, or 2, the corporation. The partnership is fairly specific and unique depending on what you're trying to accomplish. In terms of planning, these are just some of the terms that I thought would be really important for you to have an understanding of, not in any significant depth, again, just to understand, so that you can at least think of some of the things that you could be considering and or planning for yourself. And even sometimes I found that knowing and understanding some of the terms and terminologies could help me pull from my accountant or my lawyer what I thought may make sense for me, because sometimes it's not like they're discussing it with me or telling me. It's me sort of recognizing that I have a need, and I've heard of a concept or a term, and then I'm saying, how could I utilize it in my business? Because I understand, like, for example, I understand income deferral, and maybe if you don't understand it enough, you may want to, because you're as a real estate investor, you definitely want to plan and strategize, especially as you are well into the years where you're starting to plan for maybe transferring assets to family, children, as you're starting to think of how you want to set up your trusts or your estate. You want to understand how deferring capital gains could be beneficial to you, and that's where you would engage an accountant, right, to make sure that they can help you plan accordingly. Because it doesn't make sense if you have 10 properties that you would sell them all in the same year, because that would be a very very, very expensive year. So you could stagger those sales, so that you are making it more tax efficient for yourself. But one of the strategies that I had to employ, because I did start off with a lot of properties in my name rather than in a corporation, was I had to utilize a Section 85 rollover, which I didn't understand in any depth, but having taken courses and done mentorship programs, I learned about the strategy. And so I had to bring it to my accountant and say, okay, well, I don't want to keep all these properties in my name as I move forward and as I build, the build for, transferring to the next generation. So how could I, utilize the Section 81 or 85? And so then we had to, she had to do some research to get, sort of get that all rolling for me and get it all set up. So you can start where you have the properties in your name, and you can later move them into a corporation and have the tax deferred so that you're not paying the capital gains taxes at this time. You can put it off into the future again. So that's what, the Section 85 and Section 97 and many other types of strategies can allow you to plan accordingly to meet your needs over time or reduce your tax liability over time or in certain periods of your real estate career and endeavor. The retirement accounts, as I said, many times over already, especially for someone who is looking for tax deductions and, trying to plan for even building retirement assets, that the registered plans are a no-brainer. It makes sense for someone who's employed to utilize these. I would say that it would still make sense for someone who is in business for themselves or has a business that they've built and they're trying to find ways to reduce their tax liability as well. Absolutely use it. You may not, if you're self-employed and you're just starting out and you're just starting to build your income, you may not need the registered retirement savings plans as much as you would use the tax deductions that you have for your business. But eventually, they're a great tool to utilize in the tax-free savings account. Again, when I was doing investments, I always found that a lot of people I knew and a lot of people that I met, they all had extremely high contribution rooms for the RRSPs, and so too today for the tax-free savings account. And so most of us here on this call probably have unused contribution rooms and can still utilize that, so that if you're finding or you're still needing ways to reduce tax liability, these are ways that you can utilize. So additional, compliance and reporting, as I said, I'm not asking you to become efficient or proficient at understanding taxes, because you have experts that can do that. But I just feel that this session is just to help you understand some of the key concepts and some of the key areas that you have to be familiar with in order to, document, to keep the right types of filing system, so that as time passes, you've created files that could be utilized in an audit or utilized to report at tax time, right? So all of us are required to report annually. And if you're not doing it annually, then you're gonna get yourself in a bit of a pickle and a bit of mess. So you could find yourself, especially if you're owing taxes, accruing interest on those taxes. And so why do that? Why not try to stay abreast of your returns and file annually accordingly to the deadlines? Because right now we're filing for 2023 and we're expected to do it by April 30th for the average ordinary person. And for someone who's self-employed, they'll give you as late as June 15th, right? And you get until June 15th, but if you owe any penalties and taxes that you owe and interest, it's accruing from April 30th. So in general, I try to be on time, and I would encourage you to be, if you can, file within the April 30th deadline. It's better for you. So the Form T776, the 776 is the document, that form that you would submit to CRA with all your all your real estate properties. You declare your income, your expenses, and any depreciation that is being reported. And again, your accountant is doing all of this for you, but that's just the document that's used. And you're just tracking things along the way. I mean, one of the ways that I find I've used initially, I actually went into my cold room downstairs today and I found I used to do everything paper. And I found one of my ledgers of how I used to document, and I was like, oh my gosh, I'm so glad I don't have to use that anymore. So today, I use QuickBooks, and there's all sorts of software that you can use to help you track and document your income, expenses, and have that all ready for reporting. I mean, I even use Google spreadsheets and all the Google Docs so that I can keep myself and my accountant abreast of what's going on, so that I'm like on a regular basis, I have my bookkeeping being updated and keeping myself and my accountant on track, so that at reporting time, it's really, I wouldn't say it's easy, but it's a little bit more seamless to get everything done. And so there's lots of ways to keep yourself, on track and ready, so that filing is fairly seamless and it can be easily done and done on time. So it is really important. I don't think we need to know any of the lines, but your rental income, the line that it is reported on, because if you are doing it on your T1 general, that is, and again, you're not doing it. If you're doing it right, you should be having an accountant or an expert help you do it. That's the 12,600 line. And I mean, I only have to know these lines because sometimes the bank wants to know it and I have to go and look it up. Or sometimes, if I'm being spoken to by CRA, because I've had to speak with them. Last year I had an audit, and I had to actually sit with myself and my accountant, and he said I didn't have to come, but I was like, no, if it's about me, I want to be there. So I sat through it. And so, it was actually good that I was there, because I was able to help my accountant easily pull from my record keeping, and we could answer his questions and find the information that he needed fairly quickly. So it is good to be familiar with some of it, at least up to the level that, you can answer questions if called on, but mostly just pull in your tax expert to be there on the sidelines to help you manage everything. And then deductible expenses, investor in general, we have a number of expenses that I covered earlier on in one of the slides, from, mortgage, mortgage interest that you would pay. And I must say my mortgage interest has been very high in the last year, because interest rates have been much higher. So you're going to definitely want to use those as, deductions to reduce the income. I have property taxes, utility costs, if you're responsible for any of the costs in the units that you have, any repairs. Someone asked about, replacing HVAC. That's all part of it. It all falls within that. If you did any upgrades or renovations, I mean, sometimes when a unit is turned over, tenants live in it to an extent that I would absolutely, at the end of it, I detest it, and I could never show it to someone else, or I can't have a property manager show it to someone else without doing some renovations. Those renovations could include things like painting, turning over counters or bathrooms or whatever, flooring. And so all of those costs are also deductible expenses. If you're paying for property management, also a deductible expense. And all of this is reported and documented on the T776. And so, and I haven't listed them all, but those are some of the expenses that you're going to report on and track. Any questions? Does it sound familiar? Is it something that some of us are already doing? Hopefully we are. When I say that, even if it's your accountant that's taking care of it. So additionally, depreciation, again, a deductible expense. It's something, you can have your accountant track for you on your tax return. You can make sure that that is being adjusted for each year. It's up to you. Like in most cases for me, I have not been, I started out where I was doing all the tax reporting. And so I was not doing the depreciation. And so I said to my accountant, if I have to, I will, but if I don't, I'll just leave it, because you do it now, and then the capital gains in the future is greater. So, you have to look at what makes most sense for you and what your accountant advises you on in terms of taking care of depreciation. So goods and services tax, or the HST, in general, your rental income is typically not subject to the GST or HST. But there are some cases that it can be, and again, you know, you and your accountant could determine that, and make the decisions as you're making as you're reporting it. I do find that when I'm doing short-term rental, there is, you know, that HST is applied. And so, you know, if you're doing short-term rentals like that, you may have to make sure that either if you're doing it through a platform like Airbnb, if they're not taking it, then you have to account for it. And so you just have to make sure that between you and your accountant that you are addressing it accordingly if it's applicable, the HST. Okay. So that we do have to report accordingly. If, you know, in general for rentals, we're not accounting for, and we don't necessarily have to take into account HST on the income that we're generating through a rent, on our long-term leases and stuff like that. Capital gains, we've spoken to it. It's probably one of the most spoken to, you know, areas of real estate and rental properties is the capital gains. So just make sure that you understand that when you buy a property, hold it for many years, then you sell it later in the future. You bought it at 100,000, you sell it now at $500,000. That difference between $500,000 to 400,000 is subject to capital gains. Okay, and it would be reported, and even at death, it's subject to capital gains. Okay, so because it will be deemed disposed of at your death, and so if you never sold it and it transfers hands to a spouse, it's okay. No capital gains is incurred at that point. But if it transfers hands from outside of spousal relationships, so to any family member or children, it will be taxed, and the gains will be realized. See, am I doing okay for time? No. So in terms of record keeping, do it. Make sure you do it. I'm showing the old way. That's how I did it. I actually still keep files, actual hard copy files. You don't have to. It's entirely up to you. There are times where I don't think you can do without a hard copy file. There are documents that I have that I know, you know, a soft copy is not sufficient. I can absolutely hold the soft copy to be able to send it around easily to banks and institutions that need it. But, you know, surveys and appraisals and sometimes your original purchase documents, if if you were getting them in a hard copy, you need to keep them. Some of the files that I have they're embossed, and so they don't easily store as soft copy files. They can for just sharing, but there are times where you do need still the hard copy. But you should be keeping both a digital file and a digital copy, and so that's where I use Google a lot, like Google Drive, and you can also use other forms of digital storing. But absolutely, if you're building record keeping, I would highly encourage you to find a filing system that works, because if you ever get audited, you need those documents to be able to pull from, whether it's digitally or typically it's printed file. And whenever I was audited, I always had to bring paperwork. So in terms of case studies, if we have time, I'll try to get through the three that I have here, but I just thought it would be great just to show you some simple examples. This one here is John. He has a rental property he owns in Toronto, and he's incurred expenses over the course of the year. You and I, if you own properties, you're also doing that. And so if you have mortgage, interest, property taxes, so it's not the principal amounts that you're paying or the whole amount that you're paying, it's the interest that you've paid on the mortgage that is tax deductible, and the property taxes that are associated with that rental property, repairs, utilities, and all the other expenses that I mentioned before. All of those are eligible, because he's saying here, we're saying he wonders if it is tax deductible, and typically in general they are. So by keeping all the records, keeping all those files of the taxes that he paid, the repair costs, any utility bills, and most, like even if you didn't have paper bills, you can go online. Most most companies today, gas, hydro, you could even just pull it down. You can just download last year's total utility costs for hydro or gas or what have you, and it can easily be utilized for reporting. So by keeping detailed records, he can provide all of that to his accountant. I do find that I keep abreast of that on a regular basis, so that it's not just at year end that I have to do that. I'm reporting on a regular basis. My accountant does the bookkeeping for me, and so that's all being addressed as I go. If you only have one property, you may not need to do that same type of record keeping and bookkeeping that I do, but you might want to at least be tracking it, say on a Google sheet, a Google spreadsheet, or some kind of spreadsheet that allows you to see what it looks like. I like to see what it looks like anyways, because then I can look and see, am I generating more income than I am incurring expenses? Because if I'm not, then I don't want to keep it, because then it means it's not really a cash flowing property and I need to start figuring out how to unload it and sell it. So that's one of the reasons why I like the spreadsheets, because I can kind of see what's coming in each month and what's going out. And so, yes, in general, we all, as owners of rental properties, all of the associated costs to that property is it's usually eligible to be deducted. Okay, especially with keeping your proper your records, and it can help offset if it's just the one property that you have. You can absolutely report it on just your personal income taxes. If you have multiple and you have decided to go the route of a sole proprietor or a corporation, then your reporting is separately as a business. Case study 2. This client is, we're speaking here, and I gave you an example already of capital gains, but just, to reiterate, Sarah has recently sold a commercial property that she owned. So commercial property could be anything from offices to even a residential real estate, such as a apartment building, right? And she wants to understand how capital gains tax will impact her on that sale. Will she pay capital gains? Usually she will, unless she, for a commercial property, typically you can't live in it as solely, and so it's not deemed principal residence, and so she would be required to, after consulting with a tax advisor, she learns that she will need to report the capital gains from the sale of the property, right, on her Canadian tax return. And she also discovers that she may be eligible for the principal residence exemption, because if she did live in some portion of it, right? For example, if it was a multi-unit where she resided in one of the units, then she could utilize that as part of her residence. But it wouldn't, the whole portion wouldn't be, she wouldn't be entitled to the whole amount, because it's likely that she's also rented out some of the other portions and or units to others, right? So you can live in a property and it be a principal residence and have rental units that you generate income from. I'm not actually giving you numbered situations, just more scenarios. I absolutely think there, I will get our expert that comes on to hopefully give us some numbers so that we can sort of look at how it see how it looks in terms of numbers. With this one here, again, one of the best ways for someone who's employed and working is to utilize the registered plans to reduce and offset their income so that they can get those tax deductions. So David's saying, I'm self-employed. He's a real estate investor in Calgary, and he's looking for ways to reduce his taxable income and save for retirement. He wonders if contributing to an RSP could help him achieve these goals. Absolutely. The registered, that's exactly what the government had created the RRSP for, is to allow you and I, whether we're self-employed, employed, we can even have it so that our employers can contribute to the RRSP on our behalf as well, and so that it can help us build and accumulate funds for our retirement. So he analyzes his financial situation with his advisor and recommends, and he was recommended to maximize his contributions. And so maximizing our contributions could mean 18% of our income could be used to contribute to an RRSP in any one year. You can absolutely go more than that in any one year, because as I said to you, many of us have unused contribution room, and that tends to be hefty, but you never want to go so to put too much that you once you've gone to the bottom of like the taxes that you paid for that year, you've used up all of the taxes that you've already paid. Because if you're a $50,000 income earner and you put in 18%, and then you're still trying to put in another 10% of into your RRSP, there may not be any real benefits to you. You may have to defer it to a future year. And I mean, you may do that just to allow yourself to reduce your taxes and pay and not to have to pay taxes on it, but there's a point in which you will hit a threshold that it doesn't make sense to contribute anymore to your RRSP because there's no taxes to be recouped, right? So in this case for David, he probably has the room, the advisor is saying, maximize it, put as much as you can in this year, and you will end up getting back some taxes at your income at April on April 30th when you're filing. You're now eligible to get back some of the taxes that you paid in your previous tax year. So I do think the RRSP, when I was in financial services, that was one of the best ways that I could help someone who was both employed or self-employed get the most tax benefits, right? And tax deductions, especially for someone who's employed. Because sometimes when you're employed outside of maybe having children and having daycare expenses and or sporting activities, there wasn't too many other ways outside of the RRSP that you can have the tax deductions. So I did answer these two questions, and I did notice that the person that was asking isn't here tonight, but that's okay. If you inherit land from a family in the Caribbean, for example, Barbados, do you have to declare it on your Canadian taxes? Well, you should find out, does Barbados report to Canada, and do they have any sort of alliance with respect to taxes? Because if they don't, then no, you don't have to report and pay on your Canadian taxes. And likewise, for any country that there isn't any required reporting with CRA, and I'm sorry, I'm all about reducing and saving taxes. So I've chosen to invest in places abroad that don't report to Canada, and that I don't have to. And I don't care if they can, hopefully no one will share this with CRA, but in general, I have no desire to pay taxes on everything that I earn abroad. But where I do invest abroad and it's required that I report, I absolutely will report. For example, in the United States, we're required to report. And so, yes, report where need be and save where you don't have to, right? To me, that's a simple answer. And the other question I did answer already, are you able to claim the deductions for renovations on an empty rental property? And absolutely. I have units that as I said, they became vacant. They were disgusting. I would never put anyone to live in there after the state that I saw it in. So then I had to clean it, renovate it. And sometimes it doesn't get rented immediately after. And absolutely those expenses or associated costs can be used to claim as deduction against your income tax for that year, or the year in which it was earned, right? Or the work was done. Okay. So if it was in 2023, then you're eligible to use it for the year of 2023. For anything that you're doing right now, like I'm anticipating doing a renovation on a unit soon in the spring of this year. And so the deductions and the costs that I incur will be applied to my 2024 year. So some key takeaways is taxes is absolutely one of the ways that you're going to preserve your assets, preserve your wealth that you're creating. And so it's really, really important that you understand, even if you don't understand, at least get the experts that can work with you to make sure that they help you employ tax strategies to reduce today. And as you're building, to plan so that you can help reduce in the future as well, because the planning that you do today can absolutely affect how you structure and establish things for the future. And even doing estates and trusts as soon as you can, so that you can fix the capital gains and fix the value of the property, because that will also reduce the cost of capital gains and taxes in the future. So really, really important to have an accountant on side as you're building wealth. It's one of the ways to preserve the wealth that you've accumulated. So, and know, of course, that eligible for today, to help work with you today, know your eligible tax deductions so that you can understand how you can save today. And sometimes if you didn't know that you could, and you have those expenses, it's not always advisable to go back and do a reassessment, but you can go back and have something reassessed for the year in which you may not have claimed something that you were entitled to, and you still have documentation to show, you can go back. So, do it with the experts so that they do it proper, and it's, you've got someone who can account for it and respond to any questioning and or requirement from CRA to understand what you're doing. Understanding capital gains and the tax and the ways that you can reduce that as you build your portfolio over time. The structure that you choose. I don't know that everyone has to choose, as I said, a corporate structure at the outset, but if you're building and you're going to accumulate and amass multiple properties over time, then the corporate structure is one of the best ways to set up your portfolio and to accumulate assets that you may then pass on to to your children or to your family. You can always go back to the case studies and look at those. I think that we can, if you're having questions and you still have questions, this is a time to send them off to me so that when we have the experts coming on, I could have some of those questions prepared and provided to them so that they can help us understand better some of what you may be thinking about or questions that you may have. You can absolutely come to the session with those questions, but it's nice to give someone a heads up as to how they can prepare and even how they can structure their presentation. Always get the professional guidance from a tax expert so that we're not expecting you and I to be the expert. It's absolutely worth it to spend the money to have an expert take care of your needs and to help you plan accordingly the most efficient ways to work today, tomorrow, and well into the future, especially when you're looking at transferring assets to family, children. So some of the sites that I use over time that you could use are, CRAs there. Definitely you can go to the CRA website and they have all sorts of resources that can help you as you're building your business or as an investor. It can help you answer some of the questions that you may have. CMHC also has some great resources, so I would highly encourage you to go to CMHC. It's great for your real estate business in general anyways, so they're not solely just an insurance company to help provide protection on the mortgage assets that you accumulate. It's also a resource for you to help build your knowledge base and to help you be successful. So use CMHC. I also found this other site, CPA Canada, that you can also go to and use as another resource to help you, again, just build your knowledge base and just see if there's resources there that can help you with understanding some of the things that you may have questions about that you haven't been able to sort of understand. Again, you can always ask us, and if we don't know, we can get the answers from our experts. But absolutely on the next session and one of the earliest sessions in March, we're going to have a tax expert come on to help us understand better all that, some of what I just discussed and more, because it's definitely accounting and tax reporting is much more complex than what I covered. I just thought I'd mention this here. Kemba and I have been getting really excited about trying to do a lot more live and in-person events. And so one of the things that we've had a few people ask us about is going out to see properties. And so since we've got a few development sites that we've got projects going on right now, we thought a bus tour would be a great way to get everyone out to take a look at what we've got going on and what you could invest in yourself, either passively or actively, as well as if you're looking to get into the development space, you could get some better understanding. Where our goal is to not just have ourselves on the spot as experts, but to also pull in the developer or the builders to make sure that they're there at either one of the stops or at our info session, so that you can get an understanding of what that looks like. And two of the locations are in Toronto, and then most of you know that we also have a location in Brampton that is pending. Still we have to get through some of the permitting to be able to start building, right? So those are the 3 dates that we've got set. Right now, I believe if, I thought Kemba would come on, just explain. But I think right now we're making, it's a repeat each of them. So if you choose one date, it's sufficient. But our goal would then still be to, later on, is to actually do some tours where we actually get to see property. So where we'll get to go to, for example, a multi-unit. So maybe like a 10-plex or 8-plex, whatever is on the market at the time. Typically, when we go to multi-units, we don't get to see all the units. There might be one or two that's available for seeing, but then we can walk, we can do the, boots on the ground. We're walking through, we're getting to see, the perimeter, the interior, like the common spaces. We might see 2 or 3 of the units, depending on how many different style units. If there is like 1 to 3 bedroom slots, we hopefully would try to get to see at least one bedroom, 1 2-bedroom, and 1 3-bedroom. So, so that we can kind of get an idea of what those look like. And then we'd help you with trying to actually do some analysis so that you can see, and we'll tell you by the end of that tour whether any of the ones that we get to tour, and sometimes we're going to have to tour things that are close to home, that may not, always make sense in terms of cash flow, but they'll give us an opportunity to take a look at what multi-units and multifamily or commercial spaces look like, because they could be commercial residential, or they could just be commercial units as well. So that's part of what we're doing. And we also have, and I don't think we've totally revealed it, but we've talked about our Dominican trip, which is in May, and that would be May 23rd to the 30th. That's our booking period right now that we're looking at. And we'll be going to the Dominican as well to take a look at different opportunities there, so that you can invest in places where you can earn great returns and, taxed on the earnings that that you make, and the opportunities are like limitless, because you're not entering at $500,000 and greater all the time. You can buy things for 100,000, 200,000. It's a lot less costs, and entry points are much more feasible. So that, and you can get, and we're going to show you things that will give you cash flow and opportunities, great income opportunities, so that you can, and so that you can have options, right? You don't have to buy anything, but hopefully it's something that you could look at possibly doing as an opportunity to invest. We also have passive opportunities there. I right now I'm involved with one development project there that we've got actively started, and I'm hoping by that point we will be able to still get a chance to tour that site, along with some of the local opportunities that are available in the Dominican Republic. So yeah, so that's some of what we've got going on. Any questions before I wrap? No, I didn't. I'm checking the chat. I didn't see anything in the chat. Okay, well, that's it for us. As I said, if you do have questions, if you do feel that, you still are not sure about something that was said tonight, or you're thinking of as your own, as you endeavor to prepare your own taxes, because I'm preparing my own taxes right now. When I say preparing my own, I mean totally with my accountant. I absolutely cannot do it all alone. But as I'm preparing, I always have questions for my accountant, and I also always have tips and guidance for her, because I want her to do what makes most sense for me, and gives me the best options, and even well in advance of April 30th, because I have decisions that I have to make year end by December 30th, or 31st rather. And then I also have decisions that I have to make by end of this month here, February, to ensure that I have the most options. So if you have questions, share them, let me know in the email, or message me and let me know, so that I can see if I can get the answers for you, or if we could have them at our next session. Okay, thanks everyone. Thanks for listening. Thanks for joining us. I hope to see you at the next one. Our next date is February 27th. And that's where our goal is to have a tax expert out. Okay, so if we don't get I'm still going to have one in March. It's just that we're trying to work on having a second one for February, just in case some of you are still thinking, I want to get my stuff done as quickly as possible, and you're trying to plan and prepare. We'll have that expert on the 27th. Yeah, Feb 27th. Okay. Good night, everyone. Thanks for joining us.
Thank you.
Yeah, have a good night. are